Hello, everybody. It is April 21st, macro dashes, and the Federal Reserve has a message for you that you might have seen happen today for the very first time as markets become just a little bit less liquid. And I don't know that it was necessarily the Fed that did it. However, I'm sure there are market makers and big investors who are looking to squirrel away a little cash. Most of the family offices we know have already done that. So when I tell you to get to the very heavy side of your cash asset allocation for when you think the proverbial shitties are going to hit the fan, then that's what you should be doing. For the most part, I've been on the money with this for 25 plus years. 1999, I told people to sell in the strength. I was told it was different this time. In 2007, I told people to sell their second homes and to sell a lot of their stocks, and I got fired a lot. In 2016 and 15, I said that we were essentially in a sideways moving bear market, and people didn't really want to hear about it. 2018, I published the articles at the start of the year that said bet on volatility spiking. And then in going into the fourth quarter, I told people sell almost everything. In early 2020, late 2019, early 2020, I told folks that 2020 would be a lot like 2018. It sort of was. Late in January of 2020, I told folks, hey, this coronavirus is the most important story in the world. I've showed you that tweet. It is the tweet that is posted to the top of my Twitter account. About a month later, about 2 weeks before the crash really started, I said, sell almost everything. I've said sell almost everything 4 times in my career. And I'm telling you again right now that if we get a rally here in the short run, that will probably be a sell almost everything event. 75% cash, which is the max that we ever go. You never go 100% cash because, hey, we can be wrong. However, if we get a rally here, and it looks like we might, because there's a couple of things that scream rally, but there's a lot of things that scream, don't fight the Fed. So one way or another, the Fed's going to get its correction. It's just a matter of the shape. So if we get a rally, you'll want to sell into it. If we get a correction, the Fed probably has to back off because they can't kill the supply side. What is the supply side? Supply side is all the things that we need to make so that there isn't inflation. It's one thing to hold back demand. It's a whole nother thing to prevent supply. In a situation where we would raise rates to the point where it lowered demand, that probably would also lower supply. There wouldn't be enough financing to go around to produce the things that need to be made that supply chains being around the world and moving back here very slowly would be able to compensate for. So we need for Intel, we need for the oil companies and the natural gas companies and the trucking companies and everybody else that needs liquidity to be able to supply us with the things that we ask for and that we need to be able to do it. That's why there's $1 trillion. And I've told you this before. That's why there's $1 trillion set aside at the Fed in case the repo market needs bailing out. Last time the repo market got bailed out was the end of 2019, and stocks started to go up after starting to correct. It's a light form of QE, but it's QE nonetheless. We've been through this history lesson a number of times now. This is what one Fed governor said. If stocks don't fall, the Fed needs to force them. So one way or another, we're going to get a correction. It's just a matter of does it happen sooner or later. So today, stocks had a dramatic reversal as yields surged because the narrative is that the Fed has to be very aggressive. And if you're paying attention, you've got a handful of people. So most of them are the ones that I listen to. I listen to Tom Lee. I listen to some other folks who have been saying the same thing, that the Fed is going to front load things. And I talk about that in my quarterly outlook. Summary points are really all you need. Federal Reserve is going to front load the quantitative tightening in May and June and July and August. I think they might be backing off by September. Why would they back off by September? Because you just can't kill the supply side. You can't prevent companies by tightening too much from producing things that you and I want, especially energy. So what are we going to see? My guess is that the Fed does the half point in May, maybe in June. Quantitative tightening, as it gets into the third and fourth month, will start to squeeze pretty hard. At some point, something breaks, probably the repo market. And by autumn, I think they back off on the QT and the quantitative tightening. I think they stop shrinking their balance sheet. And if things get broken too badly, they'll actually put money into the market. How fast can the market go down? Really fast. You could see a 20 to 30% correction in 4 to 8 weeks. That's all it would take. The millennials, who have been more organized and frankly better trained at trading than prior generations, are ready to go. They are ready to push the put call line in the other direction. They push stocks up by buying calls, and they can push stocks down by buying puts. Remember, the entire market isn't in play. 80% of the market is owned by institutions, and they don't trade very much. So the float is what's in play. And you have some hedge funds and some mutual funds. And then the retail side, we're largely pushing that around. When the retail side all runs to one side of the boat at the same time, which they can do pretty effectively because they're all on Discord and Reddit and a little bit of Twitter still, StockTwits, wherever else they're collaborating, their chat rooms, they can run to the other side of the boat very quick. And you should think of the correction as a 1 to 2 month trade. Normally, corrections take between 3 months and 2 years. Very, very rare that they take less than 3 months. But yet, even during the COVID crash, which was the heart attack of the economy, stock market turned around in 2 months. So when we get this correction, whether it's May, June, July, August, September, whenever it is, I would expect it to be very quick to the downside. And then the pressures that are pushing it down will be removed. And those pressures are the Federal Reserve. And they mean it. It's not an accident. They're telling you ahead of time, we're going to cause a correction one way or the other. It's just a matter of it. Does it follow a rally or does it precede a rally? And this all takes place in the backdrop of the slow growth forever global economy. If you haven't read this over my investment firm or on Seeking Alpha or at Fundamental Trends, find Slow Growth Forever. Go ahead and search it in the search bar, Slow Growth Forever, and read up on it. I'll do an update soon enough, but it really hasn't changed. We have slow growth forever from demographics, aging demographics, global debt, and changes in technology to drive productivity. And that doesn't change in a year or a quarter, even 10 years. This is a generational thing. It's been going on for a generation. It's going to go on for another generation. Slow growth forever in the global economy, for all intents and purposes for us, is forever. And they need to do the Build Back Better because that will add a little bit of growth that the demographics are taking away. That'll get us our 2 to 3% GDP growth in an otherwise mature economy, is that we are replacing and improving certain things, in particular, the energy infrastructure and the communications to an extent. But really, it's going to be energy is the biggest market that's going to change. I am appearing at the Money Show in June, I believe it is, on the online version. And my presentation is Russia just accelerated the clean energy revolution. How could they have done that? Well, you've got Europe now not wanting to deal with Russia, and Japan not wanting to deal with Russia, India trying to get away from Russia, and the United States and other countries can only provide so much energy. So over the next 10 years, you're going to see the growth rate for solar and wind and battery power accelerate, not decelerate. You're going to see growth rates go from 20-something%, which is where they are now, to 30-something%. And it's going to last until most of the coal is wiped out and a lot of the natural gas is wiped out and a lot of the oil is wiped out. By the end of this decade, there will be no demand growth for fossil fuels. I think pretty certainly you're going to see shrinking demand growth for oil by the late 2020s, 28, 29, 30, right in there. And that coincides with the majority of cars being produced, which will mean majority of cars being sold, being EVs and hybrids, as Volkswagen and Ford and GM and everybody else has already announced is going to happen. And that's what they're tooling up for. So as we see these things occur, what does that mean for the economy in the short term? It means that the Federal Reserve is really just trying to prevent inflation that causes people from getting very angry. And right now, the United States, because we have extremely high employment, has been withstanding it. But if you're earning under $20 an hour right now, which is over half of the economy, it still hurts a lot. So we need to get inflation down to that 2 to 3% range by this coming winter. Probably can't do it before the winter harvest. Might not even be able to get it down that low until the third and fourth quarter of 2023. We'll see. I talked about a year or two in the article where I talked about inflation back in November, I believe it was. I said it'd take 1 to 2 years to get inflation down. And people were like, oh my God, that would be catastrophic. You know, it's not my job to call it catastrophic or not, but it's my job to know about how long it'll take. And even though I call it transitory, that doesn't mean that that's a quarter or two. To me, transitory inflation is a year or two. That's more normal. That's a more normal way to think of short term. If you're a hyperactive trader, it doesn't fit the narrative. And the narrative and the justification for a trade that you can't really justify is what traders think about. They try to get you all hyped up. So if you think about the backdrop, if you think about what really matters, you come down to a couple of things. What have I told you that matters the most? And I've been talking about it since 2012 when I said that it would go in a major bull market. It's the dollar, correct? Here's a chart from one of my articles on Blue Mountain Asset Management, 2015, I believe this is, from Rawl. Might be 2016. It's all about the dollar. Back in here, I was telling people the dollar is going to start a major bull market. Over here, he said if it breaks out, get 10 more years of the dollar going up. Well, it has broken out. I've showed you the chart. It's up in here now. We have a lot more strength in the dollar coming. Will it ever get back up to this level? I don't know. Maybe. Will it ever get up to this level? I don't know. Maybe. I think that this is in play over the next 10, 15 years. The dollar just getting stronger. Why would the dollar just keep getting stronger? Because the United States hasn't tapped major sources of revenue that can essentially balance the budget. And now that the baby boomers are almost all on Social Security and Medicare, the last ones will be later this decade, all we have to do is wait till we get to the midpoint of the boomers adding to expenses to when they start to subtract from expenses, meaning when they start to die. And while nobody likes to think of mortality and nobody wants to talk about people dying, simple fact of the matter is that demographics matter, not just births, but death. So as the average baby boomer gets to about 85 years old, which is their median expected age once they hit 65, right? When you're born, your life expectancy is lower than when you get to 20. And when you're 30, it's higher yet. And then when you get to 65, they're like, okay, you got about 20 years left. But if you get to 75, you've got like 17 years left. When you get to 85, they tell you still have a decade. So the rate at which your expected mortality sets in keeps getting pushed further out the longer that you actually live. So as the boomers get towards around 85, which is about 20 years from now, which also coincides with the millennials at peak earnings a couple of years before that. Sometime in the middle 2030s, maybe late 2030s, the United States will have seen the dollar drift higher for a long period of time, and it might peak at that point. Why? Why wouldn't it just keep going higher? Well, it could, but we'd probably break the entire world economy if it got even stronger. All we want right now is that as the petrodollar dies, because petrol is going to be less important in the future, is how do we keep the dollar strong and still enable us to deficit spend, at least until the turnover in demographic expenses. And that'll be a temporary turnover until, of course, the millennials retire in 30 years. And I don't expect that we're going to have another giant echo boom. My daughter just had 2 kids and she's like, I don't want no more. It's rough on my body. There's a lot of freaking work. I get it. Fewer people are having babies because of their religious beliefs. That was always a big one. I played poker with a guy, we call him Big Daddy. I just thought it was a poker name, and then I found out he had 12 kids. Kind of funny. Very religious guy. Believes in gambling. Plays a lot of bingo. Plays a lot of poker. It's gambling that God is there for him, I guess. In any case, it really is all about the dollar. And I've told you over and over again, if you frame everything from the standpoint of what keeps the dollar strong over time, you're probably going to come out with the right answer. If you glom onto this idea that the dollar is just going to collapse and fall and fall and fall, then you haven't been paying attention to what's been going on since the financial crisis. The dollar shot up during the financial crisis, came back down, shot back up again when things slowed down a second time. And since 2011-12, been drifting up. If you look at this from an Elliott wave standpoint, what you realize is that the dollar probably has a long way to go up. And because our economy is so strong, we could become a gigantic Switzerland at some point. We're going to be largely self-sufficient. If we're smart, we get rid of all of our tariffs, every single one. We just do like a 10% import tax. And then if you have a free trade agreement with us, we knock it down to maybe 2 or 3 or 4 or 5. Now, we're not usually inclined to make things simple because we want to always favor our buddy, the person who greased us, depending on which politician you're paying attention to, who greased who bought which politician. But the minimum income tax on corporations at 15%, which should get passed this year, is a way of saying, you know what, we'll give you all your tax breaks, all your special interests, but instead of lowering your taxes to 0, we'll let you lower them to 15. It was actually a pretty nifty move if they finally pass it. And all the Democrats are on board with that, so it has Democratic support. That's all it needs. They're going to have to pass it before the election, which means in the next several months, you're going to get Build Back Better. And if they're smart, I know that somebody's been saying it to them, more than just me, balanced Build Back Better could be a thing. Could be a campaign promise. We see that things are getting tough this summer, so we're going to do the balance, build back better. We're not going to add a penny of debt, but we're going to bail you out. Gets a lot of votes. So it's all about the dollar. Just keep looking at what makes the dollar stronger over time, and that is the policy that will emerge. Might not emerge right away. But one of the things that tightening is going to do is going to cause asset prices to go down, which is exactly what they want, because then people don't spend as if they're wealthier than they are. That's the demand side of the equation. Okay, let's take away some of this funny money wealth so people aren't spending as if they don't need to save anymore. And when they put a dent into people's real assets, then all of a sudden the debt and asset ratio changes again. For the first time ever this week, what did we find out? People have more money than they have debt. America's net positive all of a sudden. And you should expect that to continue over the next 15 years. America is just going to get wealthier and wealthier and wealthier as we have less dependence on oil and gas and coal. And as we start to produce everything that not only we need, but really what everybody needs in the entire hemisphere, if not the whole world. To the extent that we can leverage Mexico and Canada for productive purposes, and you'd think that Mexico would be pretty easy to include when we take an order and we say, okay, how do we produce it? Let's send some of the production to Mexico. Some of it will be our robots. Some of the engineering will probably come out of Canada. Some of the marketing, things like that. What you start to realize is that North America is going to be the most powerful trade bloc on the planet. People say, what about China? All those people. What about India? All those people. India is bogged down in bureaucracy. And although their two richest guys are doing everything they can to fix things, it's hard to overcome hundreds or thousands of years of bureaucracy, status levels, caste system that's entrenched. You don't necessarily acknowledge it as that anymore, but it's there. And China, who trusts China? Seriously. It's going to take generations for the rest of the world to trust China, especially now that they're in bed with Russia. And that's where a lot of our problems come from, is that this deglobalization idea, while it makes some sense from a security standpoint, it also makes the world a dangerous place if we overstep. You want an integrated global economy because then people don't usually fire at each other. Russia broke the rules. So the world said, well, if you don't want to be part of the global economy, fine, we'll kick you out. Putin didn't think it would happen, and it has. And now he's getting pressure at home. Now, he's going to declare victory, and maybe any day now. He's going to say that he won in the Ukraine. He got what he wanted in the East. He disarmed the rest of the country. Ukraine's going to need roughly $1 trillion to repair itself. Just from the building standpoint, I mean, from an emotional and psychological scarring standpoint, I don't know how that's ever fixed. I think you're going to have a couple of generations that are pretty angry and pretty damaged. And I'm not really sure that some of the things the West has done has been right. Why did Netflix pull out of Russia? Why did the Western media stop selling streaming services to Russia? That doesn't make any sense at all. Don't we want our media to be broadcasting there? Don't we want them to see a documentary on the Ukrainian war? So some of the knee-jerk reaction to what Russia did, while I understand the sentiment, the whole fuck Russia thing, the reality is that we did some dumb things. It shouldn't have been a moral crusade. It should have been a tactical strike. It should have been, okay, what can we do to get the message in there, but inflict pain on the richest Russians, oligarchs, and Putin? You know, by inflicting pain on people that are just in the regular world, they're civilians, they don't have any say-so here, you're creating bad feelings. To the extent that we needed to send that message, we should have done it through the media. We should have got it through to them. Our technology could have done it. And yet we choose to do things different ways because for political reasons, that's how it happens. As an investor, you have to take a look at all these things that are happening and say, okay, which narrative matters? Well, you want to know what's really going on in the world. You want to know why it's happening. But as an investor, you have to figure out, okay, all I'm really trying to figure out right now is if the stock market's going to go up or down. And I'm telling you, it's going to be both. We just don't know which one is first. And when it does go down, I'm telling you, it'll be quick. It'll be about a 2-month thing. It'll be a 20 to 30% correction. It'll stop when something breaks in the banking system and the Federal Reserve reverses course again. It's that simple. And there's nobody out there, no matter how certain they are when they tell you, I can tell you exactly what's going on and how it's going to break down. It's just a guess. It's all it is. It's just a guess. And they can tell you about all of their degrees and all their experience and all the things that they say that they know that matter when the other people don't know what they're talking about. They can say it over and over again. If you fall for that, let's go down to Florida and I'll sell you some swampland that I don't own. So when you take a look at what's going on out there, you take a look at what's going on with QT. This is what you need to keep in mind. Quantitative tightening is going to cause correction. It's just a matter of how long the traders can hold it off. I don't think long. I think by, as soon as May, but no later than September, we've gotten that 20 to 30% correction from the top. We're down a few percent already, the Jitterbug. And you're starting to see things occur, and the investment banks are coming out with reports. And this one, if I can get it to show up, JP Morgan. Come on, JP Morgan. There you go. They just lowered their earnings expectation for the S&P 500. Only a little bit, about 4%. We'll see if they lower it again. Just the other day, Morgan Stanley asked, are we about to see revisions for earnings downward? This is actually first. So first, Morgan Stanley asked, are we about to get to see earnings get revised downward? And then a couple of days later, JP Morgan said, yes. Yeah, we're doing it right now. So what's going to happen to the stock market as interest rates go up, as liquidity dries up a little bit, earnings expectations will come down, especially if inflation remains high in the short run, and the Fed is a little bit successful in lowering demand. How do they get around saying that they're going to have lower earnings? I don't think they can. If they know that demand is going to flatten before inflation goes down, you have a big differential between the PPI, producer price index, and their margins. We've already actually seen that. There's charts out there for that already. So PPI is still very high. And meanwhile, we're starting to see demand flatten out a little bit. There's going to be a time lag before that corrects itself. Maybe as much as a year, could be even 2 years. We'll see how fast we can get some of these semiconductors online. I mean, Intel is going as fast as they can. Taiwan Semiconductor, they're all moving as fast as they can, but it's going to take time. It's going to be hard to get a new car for a while. A lot of people are just going to wait. That's probably the right thing to do. Just wait, work, and save money. It's not a horrible idea. We probably should do that more as a more normal course of life instead of being so debt driven as we've been since the early 1980s. And as the dollar goes up, here's where we might get the opportunity of a lifetime. Emerging markets investing. When emerging markets rally, they rally hard. When they crash, they tend to crash hard. We won't invest in EEM, but this is the index that I think is relevant to look at. So the question becomes, how far are emerging markets going to fall ex China? And then you ask yourself the question, well, it's hard to know because this is a new fund. So when you look at other frontier funds, I believe the oldest one is the iShares fund, which is just FM, that one. Let me ask it to show all, overlay FMQQ. There. So FMQQ has gotten crushed since it came out. So the question becomes is this one going to fall? Are they materially different enough that it's going to change? I'm working on that. What I believe is that there's going to be an emerging markets fund that we really want to get into. And I think it's going to be this one that's getting crushed right now because it's a tech fund. It's emerging markets tech minus China. And it's just getting destroyed. But yet we know that's the future of pretty much all that business. They're skipping the mall phase. They're skipping they're skipping the ways that we did business in the 60s, 70s, and 90s. And they're just coming straight into now. So the e-commerce and the cloud-based business using the edge and Internet of Things, I think this is where we want to be. So when I take a look at this chart, there's not a good way to size it up. Because even if I break it down to a 4-hour chart, it doesn't really tell me that much. Just that it's been getting crushed for the year that it's been around, or less than a year that it's been around. But when I look at this, and I see this starting to move sideways, and I know that the dollar probably has one more rally in it. 1, 2, 3. I start to look at this, and I go, okay, where am I going to be able to buy this? And where am I going to be able to ride that huge rally up that's coming? So that's what I'm studying right now. Because I think not only are the small caps and mid caps that are eventually going to be S&P 500 companies very worth our time, I think that emerging markets technology and logistics, cloud, e-commerce are also worth our time. And that can give us the international diversification that we need and also a huge shot in the arm of growth in a world that has slow growth forever. So watch this. Watch and see what the dollar does because it's important. Let me find my calendar. There we go. My handy dandy dollar chart. We'll click all. Right. Get rid of that. Say, okay, where's the dollar going to go? It's been rising ever since I talked about it. A little bit down, maybe. If we get a rally in the stock market, this will drop down a little bit. Then when it goes up, you get your correction. Or maybe it just keeps going up. Maybe this is it. Maybe this is the spike has begun. If it gets into here, you're going to see a lot of assets just get crushed. Look, it was down in the 70s a decade ago. Now it's sniffing 100. So they had 100 today. It's at 100 today. It's a pretty big rally in the dollar. So when the inflationistas and the dollar chanters, dollar fiat currency gonna die, when those guys are chanting, you really should giggle a little bit because they don't know what they're talking about. They've been wrong for a long time. They're going to be wrong for a much longer time because the demographics say that the dollar is going to get stronger and that eventually we will tap some of the money that we have available to us, which is taxing marijuana, minimum corporate tax rate, switch from tariffs to an import tax, add a carbon tax. We don't even have to raise income taxes on a single person in America. We just start stripping the special interest stuff, tax marijuana the way that we used to tax cigarettes. There's a lot of money out there to balance the federal budget, and the pressure on the federal budget pretty much is gone by the late 2030s. In our lifetime, that seems like a long time, but in the lifetime of the country, it's a blip. It's not quite geologic time, but it's still a blip. They'll be able to work their way through that, and they will keep stealing all the way through. Somebody asked, are the holdings in FMQQ low volatility, low liquidity stocks? Some of them are, yes, and that's okay. If you're a long-term investor, lower liquidity isn't all that important, but it's not like they're low liquidity. They're just lower liquidity. You know, you're not trading Microsoft. That's also why when they get crushed, they zoom back up as the float gets soaked up. All right, I'll call it a day. I'm going to go hang out with the grandkid. You saw him at the start, and I thought he'd be a lot more interested in you, but you don't have your pictures up, so he didn't care. If we had your gallery up, I think they would have been fine. All right, I will edit this tonight when he falls asleep. All right, have a fantastic day. And I really think that if you've been fighting what I've been telling you for months, because I got an oil trade wrong 3 years ago, that really wasn't wrong if you bought the other stuff, then you're not doing yourself a favor. The correction is going to come. It's going to be fast and it's going to be hard. And you're going to want to invest as it bottoms just when you think the world is ending. And the narrative changes to, oh my God, the world's ending, right? When everybody's panicking, when everybody's telling you the end is near, just remember there's $1 trillion sitting at the Fed waiting to bail everything out. It's just sitting there waiting. So either they use it or the ability to use it is enough and things get better quick. So you want to buy this next correction and you want to buy it aggressively. All right, take care.